Hello, everyone. Welcome to the weekly roundup. Today, we will cover interest rates, inflation, and market opportunities. Hello, Ben.
Hi, Eva.
The weather has been great.
Look at this. Blue skies,
I
sun shining.
mean, I think Willie may have been right about an early spring. Fingers
I hope
crossed.
I hope so.
Let's not jinx it.
Yeah, exactly.
Okay, so we're going to start off with interest rates. The Fed signaled a pause while internal debates continue about future hikes. So, has the rate cut narrative for 2026 officially been broken?
Yeah, I think it's a good question, a good starting point. I think for all the narrative back and forth with Powell and Chair Powell and Trump just around interest rates and such, the economic numbers slightly better than expected. Unemployment was decent, slightly better in the most recent update, but a downward revision in December. So lots of, I think, cross currents. I don't know if it's just me, but the with the Olympics on right now, Trump seems to be either quieted or quiet. Not sure which one it is. So I think that's been a little bit of a break, at least from a market action perspective. And yeah, I think we'll see what happens with rates. February inflation print last year was pretty high, both in Canada and the US. So once that number falls off next month, it will be interesting to see what the annualized number looks like because we probably, at least currently, probably drop down towards 2% in both Canada and the US, barring something materially changing. But I think if Chair Powell has any say in it, he'll just sit on his hands until he's out of his job in May. And then we'll get a real sense of what's going to happen.
Yeah. So on the Canadian side, the groceries and essential benefits legislation passed,
Mhm.
and it's expected to deliver billions in direct payments to households this spring.
Mhm.
Could this work against inflation control, and could this influence future rates decisions?
Yeah, I think it's an interesting nuance and how it might fit in. The Canadian economy is still struggling and slowing. The Canadian consumer individuals are under pressure too. So it's possible. Any type of direct stimulus like this is a risk to kicking inflation back up. So I think it's certainly possible. And as you know, groceries and food have been under pressure to the upside now for quite some time. And so this would be another potential push into that portion of the inflation number. So I'd say it's a risk and something to be conscious of. I guess as I look at it, it's probably further shows that there's pressure in the Canadian economy and that it's not really expanding as quickly as maybe everyone hoped. So yeah, I'd say it's an inflation risk, but also kind of a signal to me that's saying maybe there's something else going on in the economy.
Okay. So my last question is
Hmm.
about AI. No shock
Mm.
there. AI continues to dominate the headlines. It's accelerating faster than anyone expected. Disruptions are moving even into healthcare. So my question is, where does the profit ultimately land, and how can investors best capture it?
Mhm. Eva, I think that's a great question. I think it's something that I wrestle with as well. Certainly as we've watched crypto and blockchain evolve as well, that was one of the questions that I think still hangs out there a little bit is where's the profit portion going to come? And then on the AI side, I mean, the simple ones are efficiencies, obviously. So, if you follow much of what Elon Musk is saying, he thinks that we're not going to need money because everything's going to be so efficient that we're going to have massive deflation and that everything is actually going to cost less in the future. So, I mean, that kind of thinking obviously results in increased profitability for all companies. I think that's an easy one, but I think that the technology to your point is accelerating like crazy. And I think the adoption's going to continue to go that way as well. And the small, maybe more nimble companies should have direct benefits, where the bigger, slower behemoths are going to struggle with change. And they're going to hold on for dear life because it's going to take jobs. So I think from a perspective is there's increased profitability in a lot of businesses. I'd look at companies that are people heavy. And if they're people heavy and they can be moved out, there's probably increased profitability in a lot of those businesses. To your point around healthcare, I mean, I think healthcare is embracing it at so many levels, even at the local regional levels with individual decisions for doctors and radiologists and help with reading the scans and charts and there's that nuance is happening. As for how medicines and such are evolved and specialized medicines for each individual based on your particular DNA and profile. I think that's going to be very unique in healthcare. It probably shifts the healthcare companies that focus almost reliantly on pharmaceuticals and really look to more of, I'd say, a genomic type businesses. And so I think it'll evolve, but healthcare, I think, changes dramatically. And AI is going to be huge to augmenting that. On the profit side, I'm not sure yet there. I think from an immediate short-term impact is people-heavy companies profitability increases based on AI and robotics is coming. It's just a matter of if people are going to adapt to it or not.
That'd be nice to see.
Yeah, for sure.
Let's see the charts.
All right, super. All right, so we are recording this on February 19th at around 1 p.m. as the women's Canada and US Olympic hockey team get ready to play in probably imminently in 10 minutes. So we are going to give you an update just on what's going on. Anything that happens between now and next week, I'll comment on next week. Um, well, let's start off with this. So this is history offers a warning of communication risk. And so, I'd like to follow macro markets history. I'd definitely like to think back to certain events that mirror and match maybe some of the positions that we're presently in. And so this was when Bernanke was in power in 2013, 2014. And so if we read this quote here, it says, Ben Bernanke says, we could, in the next few meetings, take a step down in our pace of purchases. So effectively saying they're going to do quantitative tightening. And this is a bit of a view at just what happened through that period. And so, we're talking the US 10-year here was at 3%. Bit of a communication risk, which really shocked the market here. And then what we got effectively a year out was lower interest rates. And so I think to your point earlier, what's going to happen? What is the U.S. Central Bank going to do from a rate perspective? I think what they say is going to have an impact on what happens to rates. I mean, we've followed a lot of different people, but one particular guy that I always have time and listen to is Ray Dalio. And Ray managed the largest hedge fund in the world and still has a great, interesting view on the world. And, his kind of take is that interest rates have to go lower, and that the US will ultimately result in some kind of yield curve control and or flattening the yield curve, moving rates Japan style back towards zero to try to fund their economy and the massive deficits they have. And so this is an interesting view, and I think it's going to be a pretty material role. What happens to the central bank? How do they voice what they're doing? Because the market react to what they're saying versus what's actually happening in the system. This one is term premia are elevated. So this again has a lot to do with what people are expecting. So as we entered this decade here, there was a lot of expectations around positive or negative, effectively with the view that interest rates would stay flat for a long period of time. And that's what we chopped through for most of 2010 to 2020. And then since we've come out of the COVID era, we've started to see effectively what this is saying is that people want higher yield in order for the risk of owning the 10-year US government debt. And so you're seeing this term premium increase material as things have gotten higher. And so I would tend to lean on the other side of this, as probably most of you know from listening to things that I've said, is that I'd say this is starting to show that, potentially the market's wrong at this point. And if the view is that rates are going to come down and flatten, then this term premium has got to come down. And that's an opportunity because right now the market's not pricing that in. And so in order to be positioned for opportunities, you have to look and see where they are. So potentially owning some bonds somewhere on the yield curve, particularly in the US, makes a lot of sense. And so this would be a chart that I continue to watch and pay attention to. A little bit more nuanced and complicated, but I thought it was an interesting view at just what's happened since coming out of COVID. And further to that, as I like to talk about bonds this week, this is an example of what's happening out there. So this is an Amazon 2.5% yield 25-year bond. And this was issued in 2020. Just to give you a sense of what was going on in the world at that point, they issued a 30-year bond at 2.5%. At the time, that would have been issued at $100 a unit. That presently $100 a unit right now is trading at around $60. So if you bought that bond in 2020, you've lost 40%. And that just gives you a sense at how much that fluctuation in the long end of the bond curve can have a positive and or negative impact on what's going on today. The yield to maturity, if you were to buy that bond today right now, is 5.43%. And so, why this is relevant and I think important just to think about is that there's a lot of pensions in the world that buy bonds. And one of the metrics and numbers that they're looking to achieve is some certainty out on the long end. Can I guarantee I'm going to get 5 or 6% for this portion of my business? It helps the actuaries calculate pension returns. So, it yields at these levels. I think it gives a lot of comfort that the fact that you have some security in the future. So, actuaries like this, pensions like the guarantee at this level. But this is long down the curve. So it's 25 years. So if you have concerns about what potentially happened to the US dollar, then you're certainly not going to like this idea. But you can buy something that trades at $60 that is going to mature at 100. So $40 capital appreciation over this period of time, potentially some fluctuation risk. So right now, this is an example of what would happen if you had put $1 million into this and you have the 25-year bond move from 4.7 to 3.7, so a 1% drop in the interest rate, you get $100,000 capital appreciation in this bond that you bought. If the inverse were to happen, if the 25-year went from 4.7 to 5.7, then you could lose 87,000 in that backdrop. So when I'm looking at areas and opportunities, initially I used to look at only government bonds, but then started to look on the corporate side. I know this is a long-winded answer, but the corporates actually have higher credit quality in some cases than government. US government trades at, we'll say double A, some say triple, but Amazon, Microsoft, these ones trade at double A plus or triple A in Microsoft's case. And so there's an interesting risk reward at having some exposure to certain areas that are under owned and under liked in the investment world. And this is one of those examples. As always, the opinions expressed do not necessarily reflect those of National Bank Financial. I have put together this report to the best of my abilities. Everyone's risk tolerance is unique and different. If you have any questions, please reach out to Eva or I, and we're happy to address them. As always, I appreciate you listening and dropping in to seeing the charts of the day.
Thank you, Ben.
Welcome.
So what's on the agenda for next week?
So we are heading towards the end of the month again. Seems like it's been a quick February.
Yeah.
So the market really has been chopping here. So I'd be looking to see what happens. There's more earnings to continue to come and follow through. A number of the tech companies have come under pressure, and so I wonder if that's a potential opportunity there. The other area we've owned energy and bought some energy names last year, end of last year. We've seen them start to hit new highs here. So I'd be watching to see what the implications are. Do those continue to go higher? Is there a risk of more unrest with the Iran situation that would obviously cause somewhat of an energy spike? And so I'd be addressing the energy names that have done well, but also saying, has tech overdone itself to the downside here, at least short term, and potentially using some advantages, some cash to buy some of those names.
Okay, great. Thank you, everyone. Remember to visit, subscribe, and follow us on YouTube and LinkedIn at Hart Investment Group. The link to our daily newsletter, The Financial Heartbeats, will be in the caption of this video or in your email box if you're subscribed. For our clients, please reach out to me if you have any questions or if you'd like to book a review meeting with Ben. Thank you once again for listening and enjoy the rest of your day. Bye.
Thanks, everybody. Bye.